Welcome back to Beyond the Benchmark, MarketWise. I'm Brad Kasper. The December FOMC meeting delivered what markets expected, another 0.25% rate cut. The new Fed funds range is 3.50 to 3.75%, but the real story is the vote, 9-3 with dissents on both sides. Governor Moran wanted a larger 0.5% cut. Meanwhile, Goolsbee and Schmid preferred no cut at all. This split makes one thing clear. The committee is trying to balance fading inflation with softening labor conditions. A textbook hawkish cut. Yes, the Fed cut rates. But the tone was hawkish, guarded, and hesitant. They removed the phrase saying unemployment remained low. Because it hasn't. Unemployment has edged higher, and labor momentum continues to cool. They also added new language about the extent and timing of future adjustments. That's classic Fed signaling. It means, do not expect a long cutting cycle from here. Dot plot, stability with big disagreement. The new summary of economic projections barely changed. The median Fed funds estimates are 3.4% for 2026, 3.1% for both 2027 and 2028, and a 3% long-run neutral rate. However, the range of projections is wide, 2% to 4%. That tells us the committee does not agree internally on where policy should go. Futures markets have been volatile for weeks. Today they show 2 cuts expected in 2026 and no cuts priced in yet for 2027. We are entering a world where both the Fed and the market expect higher for longer neutral rates, not the ultra-low rates of the 2010s. Macro backdrop. Growth. The Atlanta Fed's GDP Now model is tracking 3.8% for the third quarter. But remember, data has been delayed and messy due to the government shutdown. Private forecasts for early 2026 settle around trend growth, 1.5% to 2.5%. Inflation. Headline and core CPI are both near 3% year over year. Core PCE, the Fed's preferred measure, is 2.8%. The Fed still projects a return to 2% inflation. But in reality, the economy may be settling into a 2 to 3% range, which is historically normal. Employment. This is the Fed's pressure point. Unemployment has risen from 4.0% to 4.4%. Job creation is not keeping up with labor supply. Layoff activity is slowly ticking higher. This, more than anything, helped justify another rate cut. The bigger dynamics. We are living in a K-shaped economy. Higher income households are benefiting from rising markets, home equity gains, and upcoming tax cuts. Lower income households continue to struggle with higher food prices, higher rent, and higher borrowing costs. The Fed recognizes these pressures, but short-term interest rates can only address so much. Final takeaway. This meeting delivered exactly what we expected. A rate cut paired with a warning label. The Fed is easing policy, but it is not eager to begin a long, multi-meeting cutting cycle. For markets, that means less help from monetary policy, more reliance on earnings and economic fundamentals, and continued volatility around every labor and inflation release. The good news is this: the economy is not collapsing. Inflation is cooling. Growth is positive. And the Fed still has room to maneuver. I'm Brad Kasper. This is Beyond the Benchmark, MarketWise. Stay tuned as the data comes in.